The Frank G. Zarb School of Business, through its Merrill Lynch Center for the Study of International Financial Services and Markets, is pleased to present today's conference on the causes of the recent financial crisis and the effects of the bailout. By the end of today's program, we hope that you will be more informed and have a better understanding of the cause of the financial crisis, the necessity for a federal bailout, the impact of the bailout on financial institutions and markets, and the economy in general. To be honest, I wish we weren't having this conference at all today. Much rather focus our attention on positive things. But when you consider the mammoth impact that this financial situation that we're in is having on all of us and the historical proportions of the issues, I believe academia would be remiss in not taking an in-depth look at what's happening. And that's just what we're going to do today.
I'd like to try to cover four things today in the course of this presentation. The first is background on what it takes for a healthy housing finance system, and review some of the past and current housing finance crises. And the reason for this is the fact that, as we all know, the current crisis began in the housing finance sector. Secondly, I want to clarify exactly what caused the housing finance crisis. There's a lot of misinformation out there. And it's one of those examples of the big lie. You remember there were two big lies in the past 8 years. One is that there were weapons of mass destruction in Iraq and that Saddam Hussein was associated with al-Qaeda. That was one. That one got a lot of coverage. The other big lie that hasn't received quite as much coverage is that somehow Fannie Mae and Freddie Mac were the cause of the crisis that we faced. And nothing could be farther from the truth. Third, just some brief comments about how what started as a domestic housing finance crisis turned into a worldwide global financial crisis, which has brought the financial markets around the world to their knees and have tipped the whole world economy into what clearly is a recession. I want to go over some of the administration's response to the crisis, and the reason why I want to do that is that I would say that the most generous comment I can make about this administration's response to the crisis is that late in the game they realized that something had to be done. And lastly, some brief comments on what I think a solution looks like that is credible and defensible. And the reason why housing prices is so critical is that there is a direct link between housing prices and credit quality. You loan somebody a house in the middle of you loan somebody a mortgage in the middle of a bubble to buy a house that's highly inflated. The bubble pops, and as in the case of sort of the peak cities, you find housing prices going down 50, 60, 70%, and suddenly you wind up, as you do today, with more than 10 million households who are underwater. They owe substantially more money on their home mortgages than their homes are worth. And that is a new phenomenon in housing finance because it turns credit from the traditional analysis when you make the loan of ability to pay to also include the phenomenon of willingness to pay. If you own a house that's worth $500,000 and you're paying on a $700,000 mortgage, at one point you wake up one morning and say, this is crazy. You put the keys in the mail, mail them back to the bank, and move out. It's called jingle mail. Up until March 14, 2008, everybody understood that the government was involved in protecting the payment system of our country because the payment system and a well-functioning payment system was critical to the health of the economy. But the payment system was viewed to be depositories. And in return for being part of the protected payment system, they got deposit insurance for their depositors. They had to subject themselves to strict regulation, and they had to subject themselves to intrusive examination from the regulators. With the action in March 14th, what the government basically did said, the world of financial markets is innovated to the point where it's clear that the counterparties to derivative transactions have to be viewed as part of the protected payment system as well. So that the government, in effect, created a new de facto policy, which was, just like a depositor in an insured depository, if you hold a derivatives contract, you're protected. Seconds. It's a painful outline, and one of the reasons why I feel that the response was so poor was that this was an administration that was so committed to the ideology of the self-correcting, perfect free market that when a crisis came, they sat on their hands and did nothing until the facts on the ground became so overwhelming that they recognized they had to do something. But when the time came to do something, they lacked the policy context within which how to structure it. Third, the government needs to adjust regulation going forward that recognizes that regulation has to cover all parts and components and those entities that touch the protected payment system, and every one of those has to contribute to a risk-sharing arrangement like the FDIC so that the guarantees are provided to counterparties, depositors that are funded by the institutions that are covered by the umbrella. And the last two things, we got to deal with the tremendous overhang of excess housing in the housing market. There's over 1 million excess housing units, and they have to be dealt with because unless that's dealt with, this problem is going to drag on for years into the future. And lastly, we need a really serious, effective economic stimulus package.
You know, there were many causes of the crisis. And I thought maybe the best way to start off was to discuss what was not a cause, although it's been floated out there as responsible. There was a Wall Street Journal article, editorial, alleging that the Community Reinvestment Act was responsible for the subprime mortgage crisis. And I'd like to at least try to lay that to rest a bit. Community Reinvestment Act was created over 30 years ago to incentivize banks to lend in low-income areas. And so, in fact, the Community Reinvestment Act was around for 30 years, several decades before our current crisis. And lending under the act was fine for a significant period of time. So I thought I would just focus on 5 of them, because they certainly are not exclusive. First factor was the mortgage securitization process. Now, the mortgage securitization process had many benefits. It made credit widely available, which in many ways was a good thing. But what it also did was create an institutional demand for higher risk subprime mortgage securities that generated a higher yield. The second factor, and Allan also talked about this, was there were increasingly risky products offered out there combined with lax underwriting. One of the problems of the mortgage securitization process, and the third factor that I think was at play here, was that because of the mortgage securitization process, there was a lack of accountability in the process of origination. Mortgage lenders and originators didn't held the loans. They got rid of them as fast as they originated them and passed them on so they could be passed on to investors who would purchase them. So there was no incentive to underwrite loans with regard to the borrower's ability to repay. And one of the final factors I'd like to mention is the role of deregulation and preemption. It's really not possible to discuss the origins of the current mortgage meltdown without acknowledging the role of federal deregulation and preemption. Federal regulators did not rein in abusive practices. Progressive states like New York sounded an early alarm on the dangers of predatory subprime lending, with enforcement actions against such major subprime lenders as Ameriquest and Household Finance. However, additional state efforts to rein in predatory lending practices were thwarted at the federal level.
What I really tried to say in my talks in 05, 06, and then in 07, I think is best characterized by a quote that's attributed to Warren Buffett. I'm not sure it's actually his, but it's generally attributed to him, and that's the 3 phases of new markets. Those 3 phases being innovation, imitation, and ultimately insanity. And I was certain that as we got into 06 for sure, that we had moved into that 3rd phase, because when I saw what was occurring to the housing market in the securities market in general, but particularly mortgage securities market, I knew we had lapsed into a real problem. And what it took us 35 years, it's literally from the beginning, to develop the mortgage securities market, and yes, I am easily that old. It took us 35 years. And it's, at this point, all out the window. How do we fix this? There is not a single silver bullet to fix this problem. But we can fix the mortgage problem, and we have to fix the mortgage problem. It's the core of what's going on. Every study I have seen says that if you attack the consumer's major store of wealth, you get a different behavior. You get an effect in the consumer economy, which is at the core of what we do. I think the solution is a series of things executed violently simultaneously. I think there's the Patton quote, a poor plan executed violently is better than no plan at all. I think that's where we are. The most single important thing is a national loan modification program. And again, we know how to do it. We're going to need a couple of things regardless of the structure of the program to make this work, because the majority of the loans are not in whole loans, they're in securities. And one of the reasons, securities, when we created mortgage securities, it was never designed to restructure great gobs of loans in a security. We never thought about it. We failed in that whole notion. We were used to restructuring great gobs of commercial real estate because they were always blowing themselves up. But mortgages had always been, with relative exceptions like Houston, relatively stable. We have to not go so far, though, that we create what we are currently talking about as a moral hazard issue. We cannot turn housing into a one-way option, which means if the house value goes up, the homeowner takes out the money and runs away. If the house price goes down, he hands us back the keys, Allan's jingle mail or Richard's jingle mail. But we can't, in this attempt to deal with this crisis and be humane, destroy the whole basis of housing, in that we turn it into a one-way option. It gives everyone an incentive the minute the price goes down to send it back. But if it goes up, refinance out all the equity in the first place. Somebody asked the head of FAFA, is Fannie and Freddie a government guarantee? And he said, I think he said, almost. And the guy said, what do you mean, almost? I don't know what almost is. Either it is or it is not. And he said, no, it's almost. The result has been a much higher borrowing cost for Fannie, Freddie, and in fact the entire whole federal home loan bank system. We should go back to what we know works, the 30-year loan, the California adjustable rate loan. And if we want to have a shorter maturity loan, it's got to be something beyond 7 years, and it's got to have amortization. I mean, we need to bring the banks, thrifts, and credit unions back into the housing system as portfolio lenders. Every mortgage banker, every mortgage broker, every Wall Street firm with no money in the game, think about what the system we created was doing. Nobody had an incentive to look out for either the lender or, for that matter, the homeowner. Everybody took a fee and ran away, and everybody said, who, me? I got no responsibility. It's the fact that it's been 2 years now that many of us have been trying to make this system work and getting the system to do restructurings instead of foreclosures. Then I'm breaking ranks because at this point I'm the only major housing figure who is willing to say I'm prepared to consider a change to the bankruptcy code.
All the shoes have not dropped yet, and it's very important to be prepared for the next shoe to drop. And in the last year, and really going back several years now, there have been a number of shoes that dropped in the finance profession, and it's now spreading to the real economy. And each time it drops, the markets freak out because they either didn't expect it and they are not prepared to handle it. And as a result, the regulators, the policymakers in Washington crafted somewhat of an ad hoc approach rather than a well thought out one that is in preview of what could happen rather than reacting to it. So I'm going to talk about current conditions in credit markets and their outlook. The cost of credit, average cost of credit in terms of basis points over the risk-free rate for corporate bonds in the so-called high-yield junk bond area was 260 basis points. That's the spread between high-yield bonds and 10-year treasuries. 260 basis points was the lowest spread in the history of the high-yield bond market, modern market going back at least 30 years. The historic average is 480 basis points. And yet, if you looked objectively at the credit profile of the companies that comprise the high-yield bond market in 2007, June 12th, you might have concluded, as I did, that the credit profile was perhaps the most risky or almost the most risky that I've ever seen. So everything you've been studying in your investments classes or what you teach in the investment classes was completely out of whack. This was a situation of high risk, low return, and it just didn't make any sense. Today, by the way, the spread is over 1,600 basis points, more than 500 basis points higher than the highest spread in the history of the market going back to the beginning of the market, and this occurred in 1991. What can we expect in the next year to 2 years in this market? And we better be prepared, because I'll give you the punchline. I'm expecting double-digit default rates, maybe, I think, easily exceeding the highest default rate we've ever had in the corporate bond and loan market. And that means massive losses to lenders, the same lenders who have been in trouble in the mortgage-backed market. So if I'm right, and I'm pretty sure I'm right, at least in the right direction, then we're going to have another round of shoes dropping.
I'm going to take a little bit of a different approach. I'm going to take more of a pragmatic approach, a commercial approach, and give you my perspective as a CEO of a company that's operated in this region for the last 20 years. So we were living on borrowed money. And as that was a great way to stay drunk, to sort of put it, and enjoy that period of time, eventually the party was coming to an end. And when it came to an end, it's come to an end, I think, in a much fiercer, painful, quick way than people could have ever anticipated. Because what you've had is you've had this massive deleveraging, reducing the amount of debt you have, and at the same time, revaluation of every asset. And you have people that are trying to sell and few people there to buy. And what happens is that's becoming self-reinforcing. Everyone's trying to get rid of their stuff. There's fewer and fewer buyers. They keep lowering their price until they find a buyer that clears the marketplace. It's taken the economy and it's put us in suspended animation. So we went from this financial crisis where things weren't happening to now this crisis of confidence to now everything's stopped. People aren't lending, people aren't borrowing, people aren't spending. The new instruments, the CDOs that Lou Ranieri spoke about, and some of the other instruments that are out there that have really created an ability to use leverage like never before and devoid of any transparency as to what anyone's buying. So the new technology, these new vehicles that are out there have made it very, very difficult to understand how much risk was in the marketplace, which is another reason there's such a lack of confidence, because still you really can't tell how much risk is out there. And then the last thing, which I'll talk about specifically as it relates to that, is the mark-to-market rules in accounting, which I don't know how many people are familiar with that, but what that basically says is that when you're, particularly financial institutions, and you're regulated, you need to mark, from under GAAP, you need to mark your assets to market. Well, if you're in a situation where you're having that revaluation or devaluation, like we're seeing today, or there's no market out there for many of these instruments out there, you're in a situation where every quarter you're marking that asset to a lower and lower level. And then if someone has to sell because they're really desperate, they're really desperate, they're going to sell that, and so you got to mark yours down. So it's like me looking at Sal's watch, which is a nice watch, and let's say Sal, spent $1,000 for that watch, but he wanted to go out and had to get his wife an anniversary gift, so he needed to raise $500. So he sells it to Nancy for $500. If I own that same watch on my balance sheet, am I going to now say it's worth $500, or is it worth $1,000? And this is something that has continued to happen and really is undermining a lot of the financial institutions that are out there, because no one knows the value of their assets, not even them.
So I guess it's up to me to, you've heard all the horror stories this morning, and it's up to me to explain what the government is doing about all of this. And that really centers on the Emergency Economic Stabilization Act that was passed in early October, and the TARP program that is being implemented under that. In response to these events, on September 20th, the administration formally proposed a 3-page, 19-section Troubled Asset Relief Act to give the Treasury broad discretion to buy up distressed mortgage-related assets from private market participants with a view to infusing liquidity into the financial system. The entire act was about 800 words, and as you know, it appropriates $700 billion. So it's quite an extraordinary piece of legislation.
As was indicated, I'm going to try to take a different look at this from the standpoint of a securities regulator. What's the lessons from a securities regulator with regard to looking forward, both from the standpoint of financial responsibility and from the standpoint of market integrity? First, I think, and many of these we've begun to see progress on, there has to be an immediate effort to address transparency problems. First, with respect to products. It is not acceptable for high-volume credit default swap markets to operate in the dark. Secondly, accounting transparency. It is unacceptable for there to be a series of off-balance sheet vehicles remaining in the United States and the world. Progress has been made in that and happening in the coming months, but more needs to be done. Third, there needs to be similar addressing from the standpoint of oversight and transparency with respect to participants. Regulators need to have oversight over all major participants in the marketplace. Finally, from a financial firm oversight standpoint, both with respect to best practices in the firms and with respect to financial oversight from the standpoint of banking regulators and securities regulators, it needs to be completely rethought. All of us lived in a world of accepting risk from the standpoint of modeling and providing far too great comfort with respect to the scenarios that the firms themselves identified, scenarios that didn't begin to identify the risks that existed today. Those are, I think, just a few of the points that deserve thinking from the standpoint of financial regulation and securities regulation. We have moved to an environment in which the interrelation of markets and the level of leverage requires a rethinking of how we do financial oversight, and it requires some rethinking of how we look at oversight from the standpoint of the markets itself. And I think that will truly be the challenge for all of us in the coming months. Thanks.